Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with you all once again this week. Earlier this week, we saw the Dow Jones break out to an all-time high, but since then, we've seen selling kick back in again, many of the major indices rolling over, losing some key moving average support in the process. And as a result, now we're looking at a month of September, which typically is not very strong. Actually, it tends to be weak. And we've got some areas of the market breaking down at the same time. So not a good combination. You throw in the volatility index, the VIX, which has now moved back up above 20. And that is a combination that can lead to some lower prices and sometimes can lead to lower prices very quickly. So the whole idea today is just kind of look at some of the areas of the market that are struggling, some other areas that are showing some strength. I want to talk to you a little bit about perspective. When I look at the S&P 500, trying to keep perspective in mind. And at the end of the show, I'm going to take a look at Nvidia, because Nvidia obviously is a stock that a lot of folks follow. And I want to show you how perspective, in my opinion, works when you look at a stock like Nvidia, because I think Nvidia could go a lot lower than a lot of folks think if things really do begin to turn to the downside in a bigger way. So anyhow, let's get started by taking a look at the indices and the sectors and how they've performed over the last week. So on this chart, you can see the strength, and I've gone back this one week period. So if you pull up in summary form a chart list and then set the period to a week, you can take a quick look on a relative basis of how things in your chart list have performed relative to one another. So in this case, it's the 6 major indices that I like to follow, which is the Dow, the S&P, the Nasdaq 100, the Russell 2000 or the IWM, the MDY, which tracks the mid-cap 400, and then the Transportation Index. So those are 6 indexes, and then the 11 major sectors. So on this chart, that's what you see, 17 different charts. And over the past week, the leadership comes from both the consumer areas. So it seems like maybe Wall Street's moving over into the consumer areas because of anticipated rate cuts and what that might do for the economy. So we might be seeing a little bit more rotation into the cyclical areas. If you go down a little bit further, you'll see financials also there, healthcare, industrials down a little bit further. But for the most part, the top half of the performers over the last week reflect more defensive, more value-oriented, and more cyclical types of stocks. The bottom half, if you go down to the bottom, you'll see technology, 16th out of 17th. Technology still completely out of favor. I'd be really careful with that group until we start to see a more definitive bottom and a process of a bottom on the chart. Again, going into September, being in the first week of September and knowing what September usually means for the overall market and for technology, I'd be a little careful here. The worst performing group, though, is energy, losing almost 4% over the last week. And I wanted to show you this chart on energy first, because the XLE is moving back down into a key area of support. We had a low back around $87. That was in mid-June. Then we had another low that went below $86 on August 5th when we had that big opening gap down following that Fed meeting the prior week. Anyhow, that 86, 87 area has been support, and that goes back really over the last 4 or 5 months. And today we are trading on an intraday basis. Let me make sure I got the latest here. Right now, 87.43. So the XLE is getting close to a support level where we hope we'll see a bounce. But if we don't, it could bring the lows back in early 2024 into play. And that would be down around $78. The problem with energy this past week, and really for the last few months, take a look at what crude oil prices have been doing here in this bottom panel. Crude oil prices got up to about $87.50 a barrel back at the beginning of April, and we've now worked our way all the way back down below $70 a barrel, which is now challenging the low that we saw in December of 2023. So with the weakness in crude oil, we've had a lot of selling in that XLE. Kind of makes sense if you look at these two on a correlation basis, or you use that correlation coefficient under the indicator box. You can actually see that these two are generally kind of tied at the hip as they move up, upward or downward. So I'm not too surprised with the XLE following crude oil prices to the downside. Looking at the major indices, so we got the Dow Jones Industrial Average. I took away the annotations that I had last week, which were showing negative divergences, because I'm not really sure that the divergence, I think it's a little bit more suspect now. By definition, it's a negative divergence. We have higher prices and we have a lower PPO. But that PPO that we're looking at now goes back about 5 months, 6 months. And there just comes a point in time when I think the old highs, you just got to let them go. And it depends, I guess it's personal choice as to when that point is. A perfect example would be if you looked at the Nasdaq 100 on a monthly chart that goes back 25 years, ever since, last many years throughout this entire secular bull market run since 2013, we've been putting in lower highs from what we saw back in, and I'm talking about on the PPO. The PPO back in 2000, after that huge 1990s rally in a lot of those aggressive stocks, left us with a very, very high PPO. And no matter how high we go in price, we never seem to get the PPO anywhere near. So by textbook definition, the NDX has had a negative divergence for many, many years. Unreliable. So my point is, where is the time frame? How far do you go back? Well, when we start turning back up and we put two highs, a high and then a higher high in play, and the PPO starts to rise and put higher highs in play, I think it starts to bring the negative divergence into question. Just my own personal take on it. Feel free to agree or disagree with that. But I still see price support, same area I was looking at last week. If the market gets weak, I could easily see 38,000 on the Dow, which is about where we went to back in April, or even that breakout. Remember when we topped in 2021, early 2022, right before the cyclical bear market, we broke out above that in December of 2023, and we've never really gone back to that level. So I'm going to say 36.5 to maybe up around the 38,000 level. If I'm looking from a little bit longer term perspective and I'm thinking, hey, the market, if it does turn weaker in September and into October, it's not out of the question to see 36.5 to 38,000 somewhere down the road. I'm cautious in the near term. S&P 500 still got the negative divergence in play. In my opinion, still working. You got higher prices from beginning of April to middle part of July. And then again, just recently, the S&P went right up. Didn't quite get to a new high, but pretty darn close, kind of even. And in the meantime, we just keep seeing lower highs on the PPO. So that's a negative divergence. What I normally look for is a PPO zero centerline test or a 50, in this case, the weekly chart, so a 50-week test, which would be down around close to the 5,000 level. So again, we're looking at right now, we're just under 5,500. Another 10% or so is possible just looking at this chart. Next up, NDX, Nasdaq 100, negative divergence still in play, still looking for a reset. That could mean on the NDX, maybe a move back down to test the August low. That would at least get us another 50-week test. Perhaps we get the PPO back down close to that center line at that point. But that doesn't mean it has to stop there. And so I do have a couple of support levels in here on the NDX between about 16,500 and 17,000 that I think you'll want to keep an eye on if things do accelerate to the downside. IWM, iShares, Russell 2000, just more, not as much negative divergence because we never really had enough momentum to the upside to really have a lot of slowing momentum. But we are trending higher. I still like the IWM down the road, but currently with all the weakness that we've seen in August, beginning of August, now again as we rotate into September, it just looks like, number one, let's see if we hold the weekly or the 20-week moving average. And if we fail there, then obviously the recent lows could come into play. And I've got that range right now from about 190 to 198. And the 198 level is almost exactly on the 50-day moving average, which is just below 197, but rising. So as we fall, that the 50-week rises. It's possible maybe that's where the selling potentially would stop on any weakness. But those are the key areas that I'm watching. So I wanted to talk to you a little bit about perspective. And this is really critical, I think, when you evaluate the market. because we all get so caught up in the last, week or two, or maybe the last several weeks, that we don't go through the process of looking at different time frames to kind of see what just makes sense. I mean, use history as a guide. So here I'm going to start off first with a monthly chart that goes back 15 years on the S&P 500. Just so that you can see, the PPO got close to the center line. We did test the 50-month moving average. That was back during the cyclical bear market of 2022. We got right down to the 50 month, and we turned back up. And as we turned back up, look at the PPO. It's continuing to rise. So we've got building momentum on the monthly chart. Now, what does that mean? Well, if you pull back to say the 20-month moving average, that's kind of a normal test. I put a bunch of green arrows in here over the last 15 years to show you that when we're trending higher, a lot of times these tests of the 20-month moving average are great entry points. Where is that right now on the S&P 500? It is at 49,1307. So right at just a little bit above 4,900. Well, we know the breakout above the 2022 high was at 48.19. So 48.19 to about 49.13 from a long-term perspective would just simply be a test of a normal area. So when we think about the market going down 10%, a lot, we panic. We think, oh my gosh, it's a bear market. It's going to go on forever. I'm just telling you ahead of time, before we even see any additional weakness, that I'm okay with a move back down if we were to go down and hold this 4,900. That to me is like a worst case scenario. I don't believe we're going into a cyclical bear market or a secular bear market. I think this is going to be potentially a correction. And then I see all-time highs in the fourth quarter. So when I look at a long-term chart, I think, okay, based on my belief, what could happen this month or maybe next month? And I think worst case scenario, I think the 48.19 level up to around 49 something on the monthly chart looks like a possibility. So we move on to the weekly chart. Here we've got, I showed you earlier, the negative divergence, the possibility of moving back down to the 50-week moving average. That's kind of a normal thing after negative divergence prints. That 50-week moving average is at 5,024. So now we've got 48.19 price support. 49.13 is the 20-month moving average. And now we've got the 50-week moving average sitting at 5,024. So these are all key support levels that still reside quite a bit beneath where we're currently trading. And if we move to the daily chart, we see, okay, double top, couldn't get through. We're starting to roll back over, maybe breaking below both moving averages, the 20-day and the 50-day. And then I just, most recent lows, August, right around 51.50. That's where we opened. I think we got down close to maybe 51.20 or something intraday. And then that April low, down at what, 49.50 or so. So again, we're still talking about mostly the same numbers, a little over 4,800. Now on this chart, maybe 51.50. So it's kind of that's the range that I could see us going down into and still being fine. Now, last chart I'll show you here is just an hourly chart. This goes back 1 month. And you can see we were up. We were trending above the 20-hour moving average, which was above the 50-hour. Then we went sideways. Look at this movement below and above the moving averages consistently. We're trendless. Now, recently, we break down. We went up earlier this morning and tested that 20-hour EMA and failed. Immediately came right back down. So it's giving us the signs that in the short term we're trending lower. And until we can move back through that 20-hour moving average, that's the way I would treat the short term. But the short term, if we go down another 100 points, people start to panic. I'm just saying from a longer term perspective, it's really not time to panic. Again, if you can't stomach the possibility short term of a correction, I mean, they happen from time to time in the market. So anyway, I just wanted to point out and just show you, with perspective, that a drop back down close to 5,000 really isn't that bad given the current technical signals that we have in play. And the fact that it's September. September is the worst month of the year. Many times that we see lows in October. So September, October, we got the presidential election. Historically, we don't do well in September and October when there is a presidential election. So we got a lot of stuff still to deal with. Of course, we got the Fed, interest rates, inflation, so forth. just be cautious and just recognize that, hey, 8, 10, 12% correction from the recent high wouldn't be the end of the world. If you go over to EarningsBeats.com, if you like the way we approach the market, we do have a free newsletter. If you scroll down over on our website, you'll find an area where you can subscribe to our EB Digest, completely free, no credit card required. You can unsubscribe at any time. But I think it's some information that we pass along that will be useful and educational, and sometimes even provide the possibility of a trade if you so choose and are willing to take the risk. Please, go over to EarningsBeats, sign up. If you're on your mobile device, just go in, hit this QR code, scan this QR code. You can, you'll be lifted right then to our website, and you can come in and sign up for our that free EB Digest. All right, moving on. I want to talk a little bit about the Volatility Index. So the Volatility Index, you can see, shot up to 60 some and change back on August 5th. But we're starting to move back over 20 again. And anytime we're over 20, right now we're at 20.12, things can begin to escalate to the downside. I just showed you the chart of the S&P 500. We're downtrending. We hit the 20-hour moving average, failed right there, and then moved back down again. It's giving us signs that the market wants to go lower. And if it does, I would expect the VIX to continue to rise. And not much good happens when the VIX is sitting above 20. So again, just another little warning, just to keep in mind. Financials. I wanted to talk about financials a little bit because if you look back over the last 5 years, you can see that September, October, November, and December have been very strong on a relative basis to the S&P 500. So I pulled up seasonality, the XLF, but this is a relative seasonality chart. So how does the XLF perform versus the S&P 500? Well, over the last 5 years, it's gone up. It's outperformed, not necessarily gone up. It's outperformed the S&P 500 every year in September, and 3/4 of the years in October, November, and December. And if you look at the relative percentage gains, this is a nice time of the year for financials, no doubt about it. Now, I'm going to take you one more chart, and in this chart, same thing, financials versus the S&P, but I've drugged the slider down here 12 years. This is during the current secular bull market. And since we've been in this secular bull market for the last dozen years, look at September to December. September, October, November, look at the percentage of months that we've outperformed, that the XLF has outperformed the S&P 500. It grows starting in September. And if you look across the bottom, the average outperformance, we're at 4.3% on average over the last 12 years. That's how much the financials have outperformed the S&P 500 during the months of September through December. And if you look at the prior months, it actually is, I think, like minus 2.6%. So it's a complete flip when you turn your calendar to September. And we're just starting September. Financials look pretty good on their charts, not having a great day today, but over the next 4 months, we tend to see some really strong action in financials. So keep an eye on that group for sure. Technology. So technology still has a negative divergence. We did go down to the 50-week moving average. So potentially you could say that we've done all we need to do. But again, that doesn't mean you can't go lower. It just means that you've reset. I mean, the PPO hasn't quite gotten down to the center line, so that hasn't reset yet. But I look for PPO centerline tests and or 50-period tests after negative divergences print, or positive divergences if we're going down. So, here you can kind of see we had a lower low, slightly higher PPO, positive divergence. We went up to the 50-period, then bounced off of it, back down again, never set a new low though, and then we broke out. So maybe we go down, maybe we don't, or maybe at some point, here we rally. Well, we did rally. So this rally that we just saw could be a little bit like what we saw here before we reversed course. And that means if we're going to reverse course from this uptrend, that would mean a lower low on the XLK, which could take us somewhere down maybe to 180, 190 range from where we're currently sitting. That could be another 10% on technology. I don't think we would go much below that. At least, keep that in mind as a possibility. Financials. I just talked about the financials. I just wanted to show you on an absolute chart, they're breaking out. So we can go back and look at the technology group, which has gone down and has not gone back to a new high, and or take a look at financials, which had been consolidating and more recently broken out. Completely different sectors and completely different look on the chart. So just be aware. I just want to let you know financials have broken out, and seasonally they love the next 4 months. So what's going on with technology? Well, semiconductor certainly part of what's going on. We're breaking down again. This is on a weekly chart, but back down below the 20-week moving average. Maybe what we're going to see is just this sideways consolidation because we went below the 20, back up above the 20. Now we're moving back down below the 20. I would be watching support. I put one area of support in here right around the 16,000 level because even though we opened the week below that level, we didn't close the week. So if we close the week below 16,000, then that could lead to the recent lows that we've seen, possibly even that April low, which is down around the 13.7 area on semiconductors. And remember, we went from in October of last year, 9,000 to 21,000. Got to keep this stuff in perspective. IWF, IWD, this is one of my sustainability ratios. I like to see this ratio going higher because it tells you growth is outperforming value. In this case, it looks to me like this trend line has been violated to the downside, telling me that we could be in store for more weakness in growth versus value. And that would kind of line up with what we typically see in September and October. So this would be maybe a signal that's starting to confirm that we've got more weakness to go. Also, QQQ Spider. This is another ratio that I like to follow. And you can see right now we are sitting at about a 1-year relative low. QQQ is more aggressive than the Spider. They both can be somewhat aggressive. I mean, the Spider still has many aggressive growth stocks in it, but the QQQ is made up almost entirely of large cap growth stocks. So QQQ, when we're seeing this ratio going down, we've got to at least recognize the possibility that we are in a more difficult period in the market. I highlighted when this relative PPO goes negative. You can see it here. It's just started to go negative. The last couple of times it happened, the first time here was back in February to May of 2022, or excuse me, 2021. That's when we had the inflation scare first start. And then more prominently here, I guess, we see a lot more red in 2022 during the cyclical bear market. So it could just be that we're pulling back temporarily like we did in 2021, or maybe it's more like 2022 cyclical bear market. Personally, I don't think that's what it is, but everybody's entitled to their own opinion. Next chart I wanted to show you was the XLY XLP. Same thing. Here was the cyclical bear market. You can see that relative strength of discretionary versus staples go red in terms of the PPO. So the momentum was negative, meaning that staples were outperforming. And you can see over the last 3 or 4 months, that's where we are right now. And maybe it accelerates. I don't know. I don't think it's going to accelerate a lot. We did just break down below this relative triple bottom, went back up above, now rolling over. It would certainly point to more bearishness if we don't hold the low that we saw in the beginning of August. All right, next up, I wanted to talk about NVIDIA. So this is the one where, I mean, I think if you like NVIDIA or you own NVIDIA, you might not like what I have to say, but from a long-term perspective, keep in mind, this is down here on the bottom, we have the rate of change. It's a 2-year rate of change on NVIDIA. We are up over the last 2 years, 780%. That's unsustainable for a company this size. I'm sorry, it's unsustainable. We got up in the 700s back in 2018, and then the market went through a period of a year and a half of sideways to down action on NVIDIA before we had another big run. Then we went through another period back down to that 50-month moving average. Look at where we got over here, 50-month moving average. You know where the 50-month moving average is right now in the stock? $37, $37. We broke out at the beginning of this year at 50. So I think initially watch the 20-month moving average. 20-month moving average is 75. I think NVIDIA could hit 75. 50 might be a little bit of a stretch, but I don't rule it out. I mean, but if we go to 75, we started the year at 50. That's still a 50% increase. If you just take a step back and look at long-term perspective. So be careful about assuming that Nvidia is just going to keep going up at a pace of 780% over 2 years. Very, very unlikely. You go through these big runs and then you tend to go sideways for a while. So I would lower the bar of expectations on Nvidia. The weekly chart, we got a double top in, rolling back over. First two areas of support. First one's going to be down around 90, that August low. Then comes 75, which was the April low. And then potentially after this sideways consolidation, 50. I mean, things would have to get pretty ugly, but I would not rule out the possibility of 50. I think 75 to 90 is a little bit more realistic, but I do think 50 is definitely a possibility. Daily chart, we're just simply going sideways. Two key support levels on the daily chart, 92 and then down around 75. So we're still talking about the same things. And then on the hourly chart, you can see Nvidia was going up, went sideways, and now is rolling over and trending lower. We do have a positive divergence. So if we move lower, there's a chance maybe we put in some kind of reversing candle and at least get a short-term pop, maybe back up near 115, 116, which if you look at the daily chart, let's go back to that daily chart, 115, 116 would put you almost right up to the 20-day moving average and that gap resistance level. So it's not out of the, that's kind of what I would be looking for. Short term, maybe the month of September, 115, 116, 117, somewhere in there, I think is going to be our high potentially. And our low, I mean, it could be back down in the low 90s. And if we don't hold that, 75 becomes a real possibility. All right, that is it for me today. So what I want to do is just give you a chance to use your phone again, your mobile device, scan that QR code, come over to a page at EarningsBeats where you can learn more about how to follow me and how to follow us at EarningsBeats. We'd love to have you. If you like the way we approach the market, we give out a lot of information. And of course, we do have a paid service as well, where we provide a lot of guidance, education, and research to our members at EarningsBeats. So anyhow, I really appreciate you tuning in. These Thursday shows are fun. Wish I had better news to report in terms of the market, but it is September. We know historically what happens in September. Economic reports. This morning, we had the ADP employment report come in below expectations. Tomorrow, we get the bigger non-farm payrolls. We'll see what goes on there, what happens there. Initial jobless claims also came in again today, below expectations. So I think all of this, to me, is allowing the Fed in the middle of the month to cut rates. But the question is going to be how much and then how often are they going to cut going forward. But we'll have more information for you next Thursday, so be sure to tune in. In the meantime, please like the video, subscribe to the Stockcharts channel, and I'll see you next week. Happy trading, everyone.